All right. Hello again to all. We're almost done. This is my next to last batch of lecture slides that I'm going to record. So, good for you, hopefully. Congratulations, you made it this far, putting up with me and my annoying voice and my more annoying PowerPoint slides. But here we are. Domestic policies. We've got this and foreign policy left. So here we go. Thinking about domestic policies, the term that we use in political science more often than not is public policy, which basically just means any sort of domestic policy. And there really is no more domestic policy that's been talked about in the last, decade and change than the Affordable Care Act, about which I will say more later. But the chapter, Lowy's chapter, opens with the discussion of the Affordable Care Act. Anyway, again, I'll say more about it later, so I won't say anything now. What is public policy here? This is an officially expressed intention of the government's goals that provides rewards and punishment to promote their attainment, right? So obviously public policy or domestic policy is what governments decide, what the U.S. government decides, state governments decide, and we're often incentivized to comply, or we know we might be punished if we don't, right? Government action, whether we like it or not, either with carrots or sticks, is often required to correct what we call market failure. I don't know if we have any econ majors in here, but we really don't have a truly free market in the United States. We tell ourselves we do, right? And this gets to the heart of Katznelson's thesis that you've been reading throughout the course. That maybe capitalism isn't necessarily as wonderful as we're socialized to think it is, because it can actually lead to what we call various types of market failures. And that's what this hyperlink here is. We'll take you to, I think, a Business Insider article that talks about how markets fail. And when they can or do, they can fail in various ways. Monopolies, right, are generally not good for the economy on the whole. We could talk about missing markets, and that gets back to public goods, which we talked about earlier in the semester, and I'll say more about momentarily. We could talk about incomplete markets, like, say, for education and particularly for healthcare. Not everyone can access the market, so government often intervenes in the market to address that lack of accessibility. We could talk about unstable markets, right? If the stock market takes a plunge, it closes immediately, and the government is very interested in that. The government is interested in this, trying to provide some stability in the free market. And inequality itself is a type of market failure, which is something that you've just watched a film about, hopefully, Inequality for All, right? So governments, not just the U.S. government, not just the state of California, but all governments all across the world intervene in the economy a lot more than a lot of our free market loving friends seem to think about. But anyway, so think Katznelson at the beginning of the semester, really throughout the text, especially in the context of public goods and externalities, and then add the coronavirus, right? So, the government definitely has tried to intervene, and governments around the world, to varying degrees of success, have tried to intervene in the market to address the coronavirus, right? And externalities, remember, came up earlier in the semester, but this is another economics term that is the consequences of an exchange between two actors that has an effect on a third actor who had nothing to do with the exchange, right? So externalities are often bad, and governments often try to remedy them, right? But let's think about what role a government can play in a market economy, right? Governments are there to ensure law and order, right? Without that, if there's no government to enforce laws, then you can enter into agreement and screw somebody over in business and in life, right? Property rights are kind of important. We need those to be respected. And then again, contracts, right? And I mentioned contracts under law and order. There's overlap here, obviously, but if we can just do what we want, take other people's property and not keep our word, then your market economy is not going to function that well. And if there's not a government to enforce the rules, then your free market's doomed to fail, right? So there's a need for public policies, be them laws or rules, statutes, whatever, that express the government's goals for rewards and punishments to promote their attainment, right? To set the rules of the market. And again, this was a theme of Robert Reich's documentary that most of you have watched last week, right? So thinking about public goods again, right? This is a good that can be enjoyed by anyone, and if it's provided, it cannot be denied to anyone either. So, all types of infrastructure, education, the military, right? You don't have to be in the military to benefit from the security that the military provides you, right? Once a road is built, it's unless you're going to charge tolls, it's pretty tricky to deny access to it, right? But again, public goods are really tended to by governments because there's no private economic incentive to create them, right? So another thing, again, and I talked about externalities just a second ago, side effects of an activity affecting parties who did not agree to the activity in question. Maybe a better way to word it than I just did a few minutes ago. But government's involvement in the economy seeks to minimize or avoid externalities altogether, right? Especially when it comes to pollution. If there weren't laws against pollution, industries or individuals would probably not go out of their way to not pollute, right? We can even think about mask wearing mandates, right? I mean, like them or not, agree with them or not. It was a hot issue in 2020. And even as the virus is winding down, although new variants are coming up, wearing a mask and whether or not the government tells you to might be something that really irks you. But the goal is to minimize the externalities of the virus itself, right? So anyway, public goods, lighthouse. This is mentioned in the Lowy chapter. Nice little picture there. How about creating a labor force, right? Governments have an interest in maximizing the productivity of their labor force, and that begins with public education, right? I think it's good for democracy that people have a certain level of education, but governments and by extension, obviously employers, need people with a certain set of skills that can then contribute to the economy, right? Through their labor. Governments can seek to limit monopolies. Right, and a monopoly, if you don't recall the board game, is a single firm that provides all the goods and services of a particular market, which another way to put this is the absence of competition, right? We think competition in a free market system is a good thing, and that's true because when it's not there, when there is no competition, we're at the whim of whatever monopolistic power holds the levers of power. This hyperlink here takes you to a 30-minute monologue from Hassan Minhaj on the Netflix show, The Patriot Act. It's about Amazon. If I say monopoly, that's probably the first contemporary company that should come to your mind. But in typical Hassan Minhaj fashion, it's very informative and it's also pretty funny. But anyway, the maintenance of free markets requires reasonably easy entry and the ability to compete in the economic system, right? And monopolies take that away, really. They make it harder to enter the marketplace and they make it nearly impossible to compete, right? So anyway, how about goals of economic policy? We're shifting gears a little bit, but governments promote market stability, and again, to provide law and order, ensure competition, these things we've talked about, consistent regulatory structure, governments, whether that's the U.S. federal government, whether that's the executive branch, whether that is Congress, and then the same goes at the state level, can impose regulations on economic actors. Many economic actors don't often like them, but at the very least, the happy medium should be that the government will regulate. Actors will have to abide by them, but the more consistent that regulation can be, the more I think it's appreciated by those in the free market. Governments promote economic prosperity, and we measure economic prosperity through a few different means. We could talk about economic growth in the form of the GDP, the absolute GDP, the gross domestic product, the size of the economy. Or we could talk about income levels, and that's often measured by GDP per capita. So you take the size of the U.S. market in its trillions of dollars, divide it by the number of working people, and that will tell you how much each person, that per capita means literally just means per head. So how much each working person makes. Obviously, not everyone makes that same amount, but that gives you an idea of how much people earn within the economy. And if that number goes up, that's pretty good, right? We can also look at employment, or rather unemployment levels. Usually when unemployment is around 3% in the United States, that's considered full employment and pretty good. Everybody's pretty happy. Hasn't been that low in a while. And we can talk about inflation rates. Inflation is the rising costs, and the U.S. economy has been pretty stable for the last lots of decades, and has seen rather low inflation rates. But here you can see changes in the real gross domestic product from the mid 90s to 2020 here. And, it fluctuates. A high growth year is around 3%. That's usually considered pretty good. There have been times in the late 90s where the U.S. was above that. There's been times, and you can pretty much think about history and explain the big drops, right? The 2001 drop was after, there was a bit of an economic crisis before September 11th, and then September 11th brought about another one. You had the real estate crash in 2008, 2009, and then obviously we're seeing the effects of the coronavirus after 2019, or 2019, so into 2020, right? That's where the economy really contracted. And that's not good. Economists don't like that. The government does not like that. The federal government doesn't like that. The state government doesn't like it. Anyway, tools of economic policy. Don't dwell on this too much. I'm not going to ask you questions about this on the exam, I don't think. Monetary policy regulates the economy through manipulation of the supply of money and credit. So, whether the government prints more money or it doesn't. This is done in conjunction with the Federal Reserve System. The Federal Reserve System oversees the banking system in the United States. It sets the discount rate, the reserve requirement, which is the amount of cash banks must hold, right? So banks can't loan out every dollar that we customers or clients deposit in the bank. A bank has to have a certain amount on hold to redistribute to clients. The open market operations, this is buying and selling of government securities or bonds. So the government can, in effect, borrow money from people in the form of bonds, and promising to pay someone back with interest over a certain set amount of time. And until the U.S. economy really goes belly up, which will eventually happen, government bonds are still valued. But anyway, these are things that I don't know a lot about, so I'm not going to ask you a lot about them either. This is Jerome Powell. He's the head of the Federal Reserve, appointed under Trump, and it's one of these nominally apolitical positions. So he survived the transition and will be in office until February of 2022, I think, off the top of my head. We can talk about fiscal policies as another type of domestic policy. And when we think things fiscal and government, we think of taxes, right? So this is done by the Treasury Department, not the Federal Reserve. The Treasury Department is where the IRS, the Internal Revenue Service, is housed. It's a separate entity from the Federal Reserve. But tax policies are those that regulate the economy through the redistribution of money, obviously. And taxation can come in many forms, whether that's tariffs, which is a tax on imported goods, often then, which is passed on to the consumer ultimately. Income tax, we all pay. Corporate tax, a hot button issue in recent years in the United States. Social Security taxes we pay with all of our paychecks, comes out directly. Excise taxes are things like tobacco tax or gasoline tax. There's special targeted taxes on certain goods. The hyperlink here for corporate tax will take you to a John Oliver clip on corporate taxation, which again is pretty informative and pretty funny. We can talk about progressive versus regressive taxation, right? A progressive tax is like the income tax in the United States. You pay more as a percent of your income the more you make, right? So a wealthier person will pay a higher percentage of their income in taxes. That's a progressive tax. A regressive tax is one that in effect goes up on you the less you earn. Sales tax would be a regressive tax, right? We all pay the same amount of sales tax when we buy things in California. It doesn't matter what your income is. But therefore, if you're a billionaire and you pay sales tax on a pack of gum, you're going to pay the same amount as a very poor person will be buying a pack of gum. But as a percent of what you have, your wealth and your income, it's much less of a tax for the billionaire than it is for the poor person. That's a regressive tax, right? A lot of taxes are regressive. Most income tax and corporate tax, not just in the United States and not just around the 50 states, but around the world, most income taxes are progressive like this. So you can see this is from Katznelson, obviously. Let's see if I've got a page number 305, I believe. But you can see he often does this by quintiles. You can see the poorest 20% of the United States citizens in 2011 had cash income of $13,000 and paid less in income tax than the second quintile, right, at 26,000. Paid almost twice the amount in federal tax, and actually less in state and local taxes. But you can see the total tax there on the far column on the right is probably the most relevant. And you can see as one earns more money, one is likely to pay a higher percent of income. Although for the very top 1% here, you see that actually goes down. And why would that be? Katznelson would probably tell you that has to do with, who's in power and in whose interest the laws are made, right? But that should be a theme that you're well familiar with by now. Here you see government revenue by source. This is from Lowy, page 427. And you can see that for the first lots of years, like over 100 of them in the United States, the government was basically, the federal government at least, was run on tariffs. So no free trade, right? So whatever was being imported into the United States, the tax on that went straight to the federal government. Excise tax, again, would be like liquor tax, gas tax, tobacco tax, any sort of targeted tax such as that is what you see there. Moving forward well into the 20th century, after the New Deal, you see that income tax becomes one of the largest sources of federal income. Corporate tax is much lower. Corporations tend to pay a lot less total taxes than we individuals do. Social insurance tax is like the Social Security tax that comes right out of your paycheck. But you can see that the sources of government revenue has really diversified in the last several decades. Here is Van Vechten. We got two Katznelson chapters for this section, one Lowy and one Van Vechten. This is page 117, but gives you an idea of state revenue in 2017 and 18. Most of the revenue for the state of California came from income taxes. If I'm not mistaken, like property taxes in California are comparatively pretty low. But let's see, corporation tax is not as high as one might think it might be or should be. Insurance tax, motor vehicle taxes, right? We pay property tax on our cars, things like that. But again, most of the money that is redistributed out of Sacramento reaches Sacramento in the form of personal income tax, right? U.S. budget deficits and surpluses. This is another thorn in the side of policymakers in Washington. Everyone talks about not spending beyond our means, but it's pretty much the norm, right? Going back to the mid-'70s is when deficit spending became just pretty much the way the federal government runs its business. Most states can't do this, but the federal government allows itself to borrow and borrow and borrow. And with the exception of a few years in the late 90s and into the very early first year of this century, we saw that the federal government ran a surplus, but the Bush administration decided to cut taxes and basically cut checks to everyone because it's your money. But then instantly, the government was back in the red. And that's been the case pretty much since. Government spending as a percent of GDP. You can see this is a way to measure the government's dollars and cents role in the economy. Obviously not going to ask you to memorize anything here, but you can see government receipts, government expenditures. The expenditure number really since again the mid 70s is much higher than the amount taken in, right? So that means that the government is spending more than it brings in, and you can see this government expenditure as a percent of GDP. The government accounts for about a third of all economic activity in the United States, right? The federal government. Um, I like Katz-Nielsen. I keep using this book for lots of different reasons. I don't know. Maybe some of you really hate it, but I like it, and I like that it's very comparative. So it gives you an idea here comparing total tax revenue as a percent of GDP. The United States is around this is what the government takes in. Remember, around 25% of the economy. And that's a lot less than a lot of other developed countries, right? So that means we pay less in tax, is what this boils down to, than folks in, Sweden or the United Kingdom or Norway or Portugal or where have you, right? Government outlays, so this is government expenditure as a percent of GDP. Here the number is a little higher, it's above 40%. Other big spending states like your Sweden and your Ireland, the government accounts for a lot more. So that tells you that the government is more involved directly in the economy in these other countries than in the United States. Defense and welfare state spending, this is where most of the federal money goes out of Washington for defense and welfare. And this welfare doesn't mean government handouts. It means everything that's spent on individuals to make their lives better, like Medicare and Medicaid and things like, and education and things of this nature. But you can see that defense spending used to be much higher as a percent of federal expenditures. This, keep in mind, is right at the start of the Cold War, after World War II, or about a decade in. That number has dwindled, although it's still pretty high, right? The United States in 2010 at least spent, $693 billion on defense, and that is less than it's spent on taking care of individuals, but it's still a pretty hefty chunk of change, right? California expenditures, a bit different. Obviously, the state of California is not going to spend anything on defense because that's not what states do. But this is page 121 of Van Vechten, if you're looking along at the text. But you can see the majority of what Sacramento spends on its citizens goes to education, K-12 and higher ed together, right? Prisons, hot topic earlier in the semester, hot topic socially for a number of years. Maybe you might think that number should go up. You might think that number should go down. Right? Health and Human Services, nearly a third, right? So there it is. Deficits in California, right? So we know, I was talking about deficits just a second ago. When revenue can't cover spending, then you've got a deficit. California had a deficit of some $27 billion during the last recession in 2009. But the state borrowed money to cover the difference, and those debts were repaid by 2015. And the state has had a surplus since 2013. I believe in California, the state government cannot run a deficit. I mean, it's technically illegal. And that's the case in most states. The welfare system as a type of fiscal and social policy. The welfare state in the United States really is a product of the Great Depression, when, a lot of people became very poor in a very short period of time, right? So the idea was that, hey, maybe the government should be more involved in this imperfect economic system to try to minimize poverty and dependency, right? So the 1930s placed fiscal and social policy on the political agenda. And again, FDR ran with it. We know this. We've covered this. So a large welfare system was created to both alleviate poverty and to manipulate economic activity, right? Thus the economy on the whole. But anyway, here's a photo from Katz-Nielsen, the soup line for the unemployed in the Great Depression. I mean, Larson is old, but he's not that old. I was not around for the Great Depression, but my grandparents were, and I heard stories years ago from my grandparents that it was pretty rough. But anyway, how does social spending in the United States compare to other wealthy countries? The OECD is the Organization for Economic Cooperation and Development. It's sort of like a club of wealthy countries, and this is the wealthy country average. Last available year, I don't know when that is, 2011 or 12, comparing to 1990. So around the wealthy world, social spending went up. Whereas the United States here went up from 1990 as well, but the United States still spends a lot less than other developed countries, right? The usual suspects who really spend a lot: France, Switzerland, Austria, Belgium, and so on. Those countries spend a lot more on social welfare than is spent in the United States, right? Here's Lowy, and I do appreciate Lowy occasionally will give us some comparative data. Let's see, I don't know where this is in the Lowy text. It's on page 437. Oh, and by the way, 436 is where that soup line photo is from. It's not from Katznos, it's from Lowy. But anyway, you can see again that the United States, comparatively speaking, if you look at other similarly wealthy countries, the United States spends a lot less on social welfare than other countries. Social welfare system, Social Security is an important component of this, right? I'm sure if you've ever had a job, which many of you have, I'm sure you've paid into Social Security. This is a contributory welfare program financed by payroll taxes from people currently employed. Again, it's future recipients to pay for people who are retired now, right? Who in theory had paid into the system earlier when they were working. Social Security benefits and costs are periodically adjusted through something called indexing. So the government will, occasionally say, the federal government will say, well, we're going to raise Social Security payouts because the cost of living goes up. There's inflation. Although, as I said earlier, inflation in the United States is pretty low comparatively, but it doesn't mean that costs don't go up. So every now and again, the Social Security Administration will index things and adjust how much we pay in and how much is paid out to retired people. But Social Security politics is frequently described as the third rail of American politics because so many seniors depend on the program and everybody's paid into it, right? I worry that by the time I retire, and I'll be, retiring 20 years before many of you do, I'm worried that whatever I've been putting into Social Security ain't going to be there, right? But there's really not a lot of political will to do anything to fix the system as it is, because so many seniors, again, depend on it. They've paid into it. And remember, seniors vote in higher numbers than anybody else, right? So as people live longer and they keep voting, and I don't really see Social Security being tweaked, even though something's got to give here, right? But how about Medicare? Medicare is a national health insurance program for the elderly and disabled, and it's private health care, but reimbursed by the federal government, right? So Medicare's costs have gone up dramatically because simply the cost of healthcare has just constantly gone up for the last, I don't know how many decades. More elderly as a percent of as a percent of the population as a consequence of people living longer, which is a good thing, but it just means that taking care of those elderly people is going to be more and more and more expensive, right? Prescription drug benefit was added. It's limited. It was added in 2003, and there's talk of providing more coverage for prescription drugs for the elderly. But again, that's just going to mean more money, right? And as more people live longer into retirement, it's going to make it harder to sustain and maintain the system, right? But at the time, Social Security, that's what you see on the left here, the U.S. government poster encouraging people to sign up for Social Security, as it was really meant to alleviate elderly poverty, which the Great Depression really brought to everyone's attention. And on the whole, I think it's safe to say that it's worked. But again, the sustainability in the longer term is something that's trickier. What we see on the right here is a cartoon I found. I don't remember when or where. But the discussion of the Affordable Care Act, it was often painted as socialized medicine, right? So I want no part of Obama's socialized medicine, and he better keep his hands off my Medicare too, right? Medicare is in effect socialized medicine. It's administered by privately employed doctors, but it's government money that pays for it, right? So if you know any retired person who's on Medicare, and you likely do, they in practice are benefiting from socialized medicine. Scary. But this Medicare, Medicaid, Social Security, all of these are called mandatory spending, or they're types of mandatory spending. And I say mandatory, the term is mandatory because by law, the government has to spend this money in this way, right? So whether that's Social Security, Medicare, Medicaid, these are agreements that the government has made with us, and the government must come through. So that's why this is called mandatory spending. Excuse me. And it's become an ever increasing collective slice of federal spending in recent decades, right? It's just going up and up and up. And again, it has a lot to do with the fact that people are living longer, right? So the problem with this, though, is that you can't necessarily control for this, right? It's hard for policymakers now to know how many old people they're going to be, retired people on Social Security, on Medicare, in 2050, right? I mean, we can look at the demographics and make some projections, but you can't tell people to drop dead. So there you go, right? So this is really going to be, I think, in the longer term of the 21st century, a real domestic policy conundrum that Washington and we as voters are going to have to deal with, right? Because again, healthcare costs just go up and up. Here's from Katznelson Chapter 10. You can see that spending by the federal government has drastically increased since 1980. This is on healthcare, and state and local governments too, right? So there you have it. It's going to be tricky to manage Social Security in the longer term, in large part because of the spending on healthcare. And you can see in the United States here, private spending and public spending. The United States spends, 18% of GDP on healthcare, right? And we complain often about, they must pay a lot of tax in France and Switzerland and these places. Well, there's less money spent on healthcare, and people in most of these countries across the board, whether it's Portugal or Spain or Japan or Italy, people live longer, right? Fewer people die in childbirth, whether that's mothers or children, in most of these countries than in the United States. Outcomes in the United States are really not good comparatively. We're not getting the best bang for our buck while we're spending more than any other country on the face of the earth on our healthcare. And that includes public spending, right? We tell ourselves it's all privatized. It's not. It's really not, especially when you look at how it's financed, healthcare, that is, right? So anyway, things to think about. And I know that you college students probably don't spend a lot of time thinking about these things, but trust me, as you get into middle age, like I am, these are things that definitely cross my mind now again. But anyway, the analyzing the evidence, I don't do a lot with these in the Lowy textbook, but some of these are pretty good. This is on page 440 and 441. There's a discussion on how to fix Social Security, but you can see here that the estimated tax revenue going into the future is leveling off, if not going down, while the program cost of Social Security in the short term is only going to go up, right? So what do we do about this? Well, we could ask Americans, and that's what this data does, U.S. citizens here, percentage of citizens who support taxing incomes of over $118,000 might not be a bad idea, and a majority of us seem to support this. Support raising taxes on high-income earners. That's probably the easiest way to fix the problem and ensure the solvency of the Social Security system. But we can also flip the coin, and we could reduce benefits. We could raise the retirement age, but a lot of people obviously don't want to do that, right? Simply don't want to do that. So something's got to give, right? We either, you know, do more with less in Social Security paychecks. We raise the retirement age. We raise taxes. Something has to give, right? Um, Obamacare. I started off talking about this, the Affordable Care Act, and I told you I'd come back to it. Here we are. Again, probably the most important public policy debate we've had in this country for some time. Ironically, Obamacare, my wife asked me this not too long ago, and she's from Venezuela. She said, well, is Obamacare good or bad? And I said, what do you mean? Well, like, is the name? Like, I hear everybody says it. And the funny thing is, I thought about this. People who like the Affordable Care Act call it Obamacare, and people who don't like it call it Obamacare. Right? It's kind of funny that it's the name, both good and bad, for the Patient Protection and Affordable Care Act. Right? What this does is, in effect, requires all of us to maintain health insurance. Those of us, prior to retirement, prior to age 65, prior to going on Medicare, by law, we have to have health insurance now. And this was imposed through an individual mandate that's in the bill, the 2010 bill that passed Congress, and it was upheld by the Supreme Court in 2010. It was removed through legislation in the Trump tax cut of 2017. I repeat the word legislation there. I'm sorry. I try not to do that. Damn it. And it was the basis for a challenge heard in the Supreme Court in November of 2020. And then I do believe in the summer of 2021, the Supreme Court yet again upheld the constitutionality of the Affordable Care Act. Trump and Republicans, while Trump was in office at least, long vowed to repeal and replace Obamacare. And that really, the terms repeal and replace came about once the bill was passed. I mean, Republicans have never liked it from day one. And Republicans at the same time have yet to repeal or replace the law, right? The Republican-held Congress in the first 2 years of Trump's administration tried and failed, because the problem that Republicans face here is that folks seem to like the Affordable Care Act, those who benefit from it, right? But this repeal and replace hyperlink will take you to yet another Last Week Tonight John Oliver clip that discusses the Affordable Care Act. Other forms of support. The 1930s Aid to Families with Dependent Children was established. This was a precursor to what we call food stamps, TAMP, temporary assistance for needy families. This is done through means testing, which is a procedure that determines the eligibility for public assistance based on need and income and assets below a defined level, right? You can't just, you can't sign a contract for a job that pays you $75,000 a year and then try to go sign up for food stamps, right? You will be means tested and you will not be allowed that benefit, right? But the TAMF, or food stamps, again, is a non-contributory program. The eligibility is based on demonstrated need. You don't have to show what you've put in to get the benefit from the government, which is the way it is with, say, Social Security. But this is a program that joins the federal government and states together. It's administered by states, but paid for, in effect, by the federal government. Right. Other public assistance programs, we could talk about Medicaid, which provides medical coverage to low-income Americans. This is not the same thing as Medicare. It's similar. And Medicare, again, is provides medical coverage to retired Americans. Medicaid provides medical coverage to low-income Americans. However, there does exist something that's called the Medicaid gap. And this hyperlink, yet again, will take you to John Oliver, who will yet again comedically explain what this means. But there are millions of people out there in the United States who are too wealthy for Medicaid, so they make too much money to benefit from the Medicaid medical coverage, but they're not poor enough to qualify for Obamacare. So I don't know. I mean, I will reserve my thoughts about healthcare in the United States, but it's very expensive, and too many people, I think, fall through the cracks, right? We can talk about Supplemental Security Income, or SSI, is a means-tested program providing a minimum income to the elderly and disabled. The SNAP program, again, is an extension of TAMF. It provides food debit cards to families who pass a means test. I misspoke earlier. TANF was not necessarily food stamps. The SNAP program is, but SNAP falls under the rubric of TANF. You might see these when you walk into your local Safeway or what have you. But this indicates that you can use the Supplemental Nutritional Assistance Program at whatever place of business that is. Other types of benefits, we could talk about in-kind benefits. These are goods and services provided to needy individuals and families by the federal government, which are not cash benefits. So Medicaid or SNAP would be, in effect, a cash benefit, but any sort of direct goods or services provided to needy people are what's called in-kind benefits. We could talk about entitlements. The eligibility for entitlements is by virtue of a category defined by law. Categories can be changed only by legislation, and this gets back to that mandatory spending that I was talking about earlier. Social Security would be an entitlement. If you've paid into it, you are entitled to it. And that's not entitled, kind of has a bad connotation this day and age, but an entitlement in this context is just something that you simply are owed by the federal government by virtue of having paid into the system. You are entitled to Social Security if you've paid in. Welfare reform was a real big, hot social issue going back to the Clinton administration in the 90s. But the idea of welfare, any sort of public assistance, is often scoffed at by many of us because it contradicts this notion that we have of traditions of individual hard work and bootstraps and this, that, and the other, overlooking a lot of the market failures that exist, say, in when it comes to healthcare or education or what have you. And welfare, has a really negative connotation to it because we in the United States often just jump to the conclusion that it's bad and it's for lazy people. And again, in the 1990s, welfare reform was really advocated by the Clinton administration, and Republicans were on board. And everyone was happy because you could demonstrably see that by reforming the system, fewer people benefited from welfare, but it didn't necessarily mean that those people weren't poor anymore. That's the problem, right? So welfare reform had little impact on actually reducing poverty rates in the United States. So this is from the Lowy text. Should be toward the end. Yeah, this is on page 444. And you can see that after the reforms of the mid-90s, the number of families benefiting from any sort of social programs drastically reduced. But that does not mean, again, I'll repeat myself, that does not mean that poverty went away, right? And keep in mind, you've watched the Inequality for All film. During these years, inequality in the United States just increased. It skyrocketed comparatively. So, again, just because you don't have as many people on welfare doesn't mean that the problem's been solved, right? The problem of poverty. This is my last slide. This is from the Katznelson chapter 10. I'm not going to find the page number right now, but since many of you have probably worked some pretty crappy jobs, I know I did when I was in school, in college. The federal minimum wage hasn't gone up in forever, right? It hasn't gone up. It still is $7.25, and it only went up to $7.25 in 2009. It hasn't budged since. So that might be just one way to think about how to alleviate poverty. Maybe, crazily, we could pay people a living wage, right? And you can see comparatively that $7.25, when adjusting to use what $1 was worth in 1996 as the index, so the $7.25 is actually in purchasing power gone down, and I'm sure it's even well below $4.97 today. So here we are. But that might be one way to start to address some social policies and to try to get people effectively off of government support. But anyway, there it is. That's my 2 cents. Reasonable people can disagree on a lot of these issues. So, don't take what I say as gospel. But there it is. We've got foreign policy coming up, and that's it for the slides. So anyway, good luck to you. Be in touch. Take care.